All right, welcome. Today, we are going to pull back the curtain on the hidden mechanics behind every single trade you make. We're getting into three concepts that are, seriously, the bedrock of the entire market: liquidity, volume, and the bid-ask spread. So let's just dive right in with a question. I'm sure this has happened to you. You go to buy or sell a stock, you see the price right there on the screen, but the price you actually get is just a little bit different, right? It's not a glitch in the system, it's the market's engine at work. And we're about to pop the hood and see how it all runs. So what is going on there? Well, that price you see quoted everywhere, it's simply the price of the last trade that happened. It's history, even if it's just milliseconds old. The price you're about to pay is determined by three really powerful interconnected forces, and we're going to break them all down. And hey, this all ties in perfectly with what we talked about last time with order types. Market orders, limit orders, all that stuff. That was about how you tell your broker what you want to do. Today is about understanding the world your order is actually stepping into. Okay, let's kick things off with our first two concepts, and honestly, they're like two sides of the same coin: volume and liquidity. And to make this super simple, just think of a marketplace. Volume is the size of the crowd, and liquidity is the energy of that crowd. First up, volume. It is pretty much exactly what it sounds like. It's just a raw count of activity. How many shares of a stock have actually changed hands over a certain period, which is usually just a single day. So back to our marketplace idea, volume is just the size of the crowd. Is it a massive, bustling city market with thousands of people yelling and making deals? Or is it more like a quiet little roadside stall with just a few people wandering by? That difference, that's volume. And just to put a real number on it, let's imagine our favorite stock, Explainer Co., traded 10 million shares today. That is the sign of a very large, very active crowd. Now that huge volume leads us right into our next concept, liquidity. See, this isn't just about how many people are in the market. It's about how easy it is to do business there. Can you buy or sell your shares quickly without totally messing up the price? So if volume is the size of the crowd, then you can think of liquidity as the flow and the energy of that crowd. In a really liquid market, it's incredibly easy to find someone to buy what you're selling or sell what you're buying, almost instantly, and at a fair, stable price. The whole thing is just smooth. Okay, so we've got the size of the crowd and we've got its energy. But what does it actually cost you to get in and play? Well, that brings us to our third piece of the puzzle, the bid-ask spread. And you can think of this as the cost of admission to the marketplace. You see, in any active market, there are always two sides competing. You got the bid, that's the highest price any buyer out there is willing to pay for a share right this second. And on the other side, you've got the ask, which is the lowest price any seller is willing to part with their shares for. And the gap between those two numbers, the best bid and the best ask, that's what we call the bid-ask spread. Even if it's just a penny, that little gap is the fundamental transaction cost. It's basically the fee that market makers earn for being there, ready to buy from you or sell to you at a moment's notice. Let's circle back to our Explainer Co. stock. So you can see here, buyers might be bidding $9.95 a share, while sellers are asking $10.05. That 10-cent gap between the bars, that is the spread. If you want to trade right now, you have to cross it. Buyers pay the ask price and sellers receive the bid price. So we've got volume, we've got liquidity, and we've got the spread. Now they might seem like separate things, but they are totally, completely linked. This is where we connect the dots and it all clicks into place. This is the aha moment. This table right here, this connects everything. For a highly liquid stock, our busy market, you naturally have super high volume. And because there are so many buyers and sellers packed in there, it's really easy to trade, which means liquidity is high. And with all that fierce competition, the gap between the bid and ask prices gets squeezed down to almost nothing. We call that a tight or narrow spread. And of course, the exact opposite is true for a low liquidity stock, our quiet little stall. Low volume, it's harder to trade, and the spread is much wider. So if there's one thing you remember, make it this. The size of the crowd dictates the energy, and the energy determines your cost of admission. A bigger, more energetic market almost always means it's cheaper for you to get in and trade. All right, so that's the theory. But, the whole point here is to give you something you can actually use. So let's turn all this knowledge into a practical, simple toolkit. Here it is, a simple 3-step checklist you can run through before you make any trade. First, check the stock's average daily volume. Is the crowd huge or tiny? Second, look at the live bid-ask spread right now. Is it a penny or is it like 50 cents? That tells you your immediate cost. And third, think about your own order size. Come on, buying 100 shares of a stock that trades millions a day is a piece of cake, but trying to sell 5,000 shares of a stock that only trades 10,000, well, that could be tricky and it could cost you. So let's wrap this all up with the 3 big takeaways. Number 1, volume is just the size of the trading crowd. Number 2, liquidity is the ease of trading within that crowd. And number 3, the spread is your direct cost for that ease. Size, ease, and cost. That's the whole relationship right there. And that brings us to a final question for you to think about. Now that you can actually see these hidden mechanics, these hidden costs, how are you going to look at the next hot stock you hear about? Are you just going to see the potential upside, or are you also going to see the potential cost and the risk hiding inside that spread? Understanding this stuff is absolutely crucial for where we're going next. In our next explainer, we're going to build on this foundation and explore what really moves prices in the first place. Everything from big news events to subtle shifts in market sentiment. Thanks for joining us.